So, when was the last time you really looked at your high-yield savings account? Not just a quick glance at the balance, but at the actual interest rate. Because I've got to tell you, your bank might be quietly dialing down that amazing rate they advertised, and you probably wouldn't even notice. We're going to dive into what's happening behind the scenes, because this little trick is costing people some serious cash.
This quote right here just nails it. It's not some big dramatic event. It's quietly infuriating. You log in, you're expecting to see that solid APY you signed up for, and it's just a little bit less. There's no email, no alert, no heads up. It's like your interest rate just ghosted you.
And that's the big question you have to ask yourself, right? Is this happening to you? Because if you're letting a nice pile of cash just sit there, thinking it's working hard for you, you might be in for a surprise. And what I've learned is, this isn't random. Oh no, it is a very deliberate strategy.
Yeah, there's a name for this whole game. It's called front-running the Fed. See, the banks aren't waiting around for the Federal Reserve to make some big announcement. Nope. They're making their moves weeks, sometimes even months ahead of time. And they can get away with it all because of two little words buried deep in the fine print.
And here they are. Variable rate. This is the whole secret. When you opened that account, you saw that big, flashy APY on the banner ad. But that number? It's basically just marketing. It is not a promise. The bank has absolutely no obligation to keep paying you that rate. They can change it whenever they want for whatever reason they want. So how do they decide when to pull the trigger and cut your rate? Well, they're not watching cable news for Fed announcements. They're watching something way more predictive, the bond market. You know, where all the big money traders are placing their bets on what the Fed is going to do in the future. When those traders start expecting a rate cut, bond yields fall. And that drop, that's the smoke signal for your bank to start quietly cutting your APY.
This timeline just lays it all out perfectly. Look at this. We're 6 weeks away from an official Fed meeting, and the bond market is already sniffing out a cut. Then, a whole month before the actual announcement, your bank starts chipping away at your rate. So by the time you see the headline on the news, it's already old news for your savings account. The damage has been done. You're already late to the party.
Okay, so what's the real-world cost of all this? Let's actually put a number on it. And we're going to give it a name, the lazy tax. It's exactly what it sounds like. It's the price you pay for just letting your money sit there on autopilot when the environment is changing. Let's use a real example to make this stick. So this is David. He's got about 45 grand saved up. Good for him. Now he's at a fork in the road. Path 1 is the easy path. Just leave the money in his high-yield savings account and let that 4.65% rate slowly get whittled down over the year. Path 2 takes a tiny bit of effort. Move it into a CD and lock in a slightly lower but totally guaranteed 4.50% rate. And boom, here's the final score after 1 year. The easy path, the HYSA, earned him $1,850. Not bad, but the fixed rate CD, over $2,000. You see that gap between the two bars? That right there, that is the lazy tax, in plain sight. Let's be really clear about this. For David, the lazy tax was $206. That's the price he paid for convenience. That's money he lost simply because he didn't take 15 minutes to make a few clicks and move his money. It's a totally avoidable fee for doing nothing. All right, enough about the problem. Let's talk about how to fix it. Because you are not powerless here. It's time to go on the offensive. You have a whole arsenal of tools you can use to fight back and lock in those high yields. So let's gear up. We're going to focus on 3 main strategies. They're all super effective. It just depends on your situation. We've got the no-penalty CD, the classic CD ladder, and for some of you, Treasury bills or T-bills. Let's break them down. Okay, first up is the no-penalty CD. Honestly, this thing is like a financial cheat code. You get to lock in a great fixed rate, usually for about a year, so you're protected from any cuts. But, and this is the amazing part, you can pull your money out whenever you want after the first week without paying a single penalty. It's the security of a CD with the freedom of a savings account. Next up, the CD ladder. This one sounds more complicated than it is, but it's brilliant for larger sums of cash. You just split your money into a few different piles. You put one chunk into a 6-month CD, another into a 9-month, and another into a 12-month. What this does is it locks in today's high rates for the long term, but it also gives you access to a chunk of your cash every few months as each CD rung on the ladder matures. It's the perfect balance. And listen up, this last one is for all of you living in high-tax states. I'm talking New York, California, you know who you are.
You need to be looking at Treasury bills. Why? Simple. The interest you earn is totally exempt from state and local taxes. So a T-bill that's paying, say, 4.3% could actually put more money in your pocket than a 4.8% savings account once you factor in the tax savings.
Okay, so we get the problem, and we know the tools to fix it. Now it's time to put it all into practice. Let's make it super simple. Here's a 3-step action plan you can literally do right now to get your cash working smarter.
Step 1. Figure out exactly how much money you need to be able to get your hands on within 24 hours, your absolute true emergency fund. Whatever that number is, keep it in your high-yield savings account for quick access. Step 2. Audit everything else. That extra cash just sitting there, that is your lazy cash, and that's what's costing you money. Step 3. Execute. Move that lazy cash into a no-penalty CD or one of the other fixed-rate tools we talked about. Lock it in.
And hey, if you really want to see how this impacts you personally, you should check this out. The Daily Fiscal built a calculator where you can plug in your own numbers. It'll show you exactly what your personal lazy tax will be if you don't do anything. Trust me, when you see that actual dollar amount, it really lights a fire under you.
And that really brings us to the bottom line, doesn't it? The banks are playing this game with ruthless efficiency. They are actively and aggressively managing their finances to maximize their profits. The only question left is, are you doing the same for yours?